Hey guys, Dave Keller here with Market Misbehavior. There's no denying that the market is showing remarkable strength, but it's led by a relatively narrow group of stocks in a relatively narrow group of sectors. As a matter of fact, today we're going to look at some sector relative strength charts that show you it's basically technology and then everything else here as we get started with Q3 in July. What's interesting though is one of the tools I use often is called my Market Top Checklist. It's something I share and refer to with my Market Misbehavior Premium members. One of the items of 7 items on that checklist is to look for an improvement in defensive sectors. So while I think this set of charts partly tells us the story of the dominance of technology, I think embedded in those charts also will most likely give us a fantastic signal about when that dominance may be over and when a likely summer top is actually happening. Before we get to the charts and the setups I'll be looking for, here's one more thing I wanted to tell you about. Today's video is brought to you by Seeking Alpha's Alpha Picks. The Alpha Picks product is essentially an institutional quality alpha model or quantitative model. What you do is you look at the characteristics, the factors that describe a stock just before it really starts to do incredibly well, and you look for those historical winners and try to back into what you could have identified before they really started to grow. They look for those same powerful combinations of factors in the markets today. One of the stocks that they highlighted back in November of 2022 was a smaller company called Super Microcomputer. That name might be familiar because it's gone on to become one of the top performing names of the S&P 500 in the first half of 2024. They are now looking for the next Super Microcomputer, those next big compounders that will have periods of potentially explosive growth. If you go to marketmisbehavior.com/alphapicks, you can have access to an institutional level model like their Alpha Picks product. Now it is in an affiliate link, which means it gives you a better deal than you would have normally and also helps me to make Market Misbehavior awesome. So if you go to marketmisbehavior.com/alphapicks, you can find more information about the special deal that they're running around the 4th of July holiday. I hope you can check it out and help identify one of those next big winners. Now let's get back to the charts. All right, so before we get into a deep discussion of sector relative performance, let's just start things off by thinking about the big picture here. Coming off the October low of last year for the S&P 500, the end of last year was basically in a position of strength, right? We'd overshot the July peak. We'd recovered 100% of the losses from third quarter, and fourth quarter had finished quite strong. And the question was, will that uptrend continue? In Q1, it was absolutely continuing. Now, there were certain types of names that were doing better than others in that quarter. The sector relative charts will answer that question for us very, very easily. Then we had the pullback into mid-April, and I would argue that while the January, February, March period and May, June, early July period look very similar in terms of the chart of the S&P 500, when you look at the sector relative charts, you can see those are two very different market environments. I think that's one of those issues that investors have, particularly during a protracted bull market advance, right? As the market, as defined by the benchmarks, keeps going higher, we just assume that all the conditions are the same. That's why I love to look at charts like sector relative performance, like breadth indicators, like the charts of leading names that have been driving performance up to a certain point, because those charts will tell you, help you define the current conditions, but also tell you what you would need to see for to understand that those conditions may be changing. And that's why I think that these charts I'm about to show you are so vital here as we get into the third quarter of 2024. So the real question is, will this advance continue, which we think it does to a certain point, and then what will tell us that there's a major top, which we feel in summer 2024 is incredibly likely. Well, I'll tell you what, as we think of that period from April, May to June, here we're looking at a series of charts, which I call my sector relative strength charts. I have 3 sets of charts to show you, and then a fourth one with a sector that I don't think fits into these buckets very well. This first group of sectors are the value-oriented sectors. Some would call these the cyclical sectors. Industrials, financials, materials, and energy. These are sectors that tend to do well when the economy is in good shape, when conditions are thriving and the economy is growing. These are the companies that tend to do quite well in that environment. If you look at what has happened from mid-April to now early July, all 4 of these sectors have been underperforming. And again, these are simple ratio charts looking at the sector ETF like the XLI, and then the denominator of all of these series is the same. It's the SPY, the S&P 500 ETF. So if these lines are going up, which they all were in February, March, April, that means that sector is outperforming the S&P 500. And that's what I was saying, that first quarter of this year had a particular configuration while the markets were going higher. Most sectors were doing quite well, particularly value sectors. But if you think from the mid-April low to where we're at now in early July, all 4 of these value sectors have been underperforming. So by owning industrials or financials or energy for the last couple of months, coming off the April low, even though the benchmarks went higher, you probably underperformed during that whole period because it was other sectors that are actually getting it done. The second set of charts shows the growth sectors. From the top, we have technology, then communication services, and then consumer discretionary on the bottom. Now, consumer discretionary has popped a little bit in the last couple of weeks, and that's because Amazon's making new highs. Tesla, which was an absolute dog of a stock compared to the other mega cap leadership names, actually started to get it done here overall in the last week or two. As a result, the XLY is starting to turn up a little bit, but overall, year to date, consumer discretionary has been a really ugly place to be. Communication services has essentially been the market. While you have some really strong names like Meta and Alphabet that are in that sector, overall, that's pretty much matching the returns of the S&P. So you're gaining money by owning communication services, but you're not outperforming. The top series shows you what I think is the story of 2024 year to date, and that's Q1 as a period where technology underperformed and Q2 as a period where technology outperformed. Back here is when all the value sectors were working and technology and consumer discretionary were underperforming pretty dramatically. From April on to May and June and now into July, technology has been by far the top performer and nothing else is even close. Communication services is second, which is about flat for that period on a relative basis. It's pretty much own technology or underperform so far in the last couple months off of that April low. So now we see the dominance of technology, and compared to all the other what I would call leadership sectors like growth leadership or value leadership, technology has been the only place. And that's been Microsoft, Apple, but really a lot of semiconductors like NVIDIA and Applied Materials and others like that. Now, where does that leave us? Well, the bucket of sectors remaining, these 3 sectors are pure defensive sectors, things like utilities, consumer staples, and real estate. And while utilities did have a brief rally there in April and May when all the utilities earnings calls were talking about data centers and all the power needs of AI and the potential growth in AI, and all of a sudden utilities were a growth story, that went away very, very quickly because you can see from mid-May to now early July, utilities has once again started to underperform. I think this is probably the most important chart out of the 3 that I'm showing you here because I think this, along with the chart of technology, shows you the current configuration. It's been technology working, value sectors not working, defensive sectors not working. One of the 7 bullet points on my market top checklist is an improvement in the relative strength of defensive sectors. Because more often than not, the only real time that utilities, consumer staples, and real estate stocks have a decent run of relative performance is when investors are getting nervous. And instead of owning growthy stuff or value stuff, they want to get defensive and just own things with a decent dividend, relatively low volatility so that they can weather periods of uncertainty. So if the market follows its usual seasonal pattern, which means a major peak is most likely coming in July or August and go down into an August or September or even October low, which is what the playbook has been over the last 5+ years, then you would most likely see a rally in defensive sectors because everyone right now in a very crowded trade in technology, if they would unwind those positions because they're overextended and start to rotate into more defensive positioning to ride out a pullback, these utilities charts would all start to rotate higher. These defensive charts, that is, utilities, consumer staples, and real estate. Generally speaking, those are sectors you usually don't own unless you're looking to not own other things. And you own REITs or consumer staples in particular if you're looking for a high dividend, relatively low volatility, which means if the benchmarks go down, you'll probably go down a little bit less, and you have the income component, which means it provides you an opportunity to outperform on the way down. I think this is the most important chart to be watching here in the third quarter, because at some point defensive sectors start to improve. That would most likely signal the end of this raging bull market phase that we've experienced so far in 2024. By the way, have you figured out which of the 11 S&P sectors was not represented in those three charts? It's healthcare. Healthcare is a tough one to bucket, and I would say even with the buckets that I made of growth and value and defensives, it's hard to bucket sectors because they all have offensive and defensive capabilities or characteristics at different times in the cycle. I think healthcare is one that I don't include in those for two reasons. Number one, I think it's a very diverse sector. Healthcare actually has some very offensive, like biotech, and very defensive, like a big pharma, all mixed into one particular sector. And the other thing is the relative performance has been consistently weak through the last 12 to 18 months, all the way back to the end of 2022. So generally speaking, healthcare has just not been a good relative bet in any environment in recent market history. What do you think of this breakdown of sector relative performance? Would you agree with my assessment that defensive sectors are the ones to watch? And what do you see as the likelihood for a major market top in July, August, or September? Let me know in the comments below what you are seeing for the markets here in Q3. For Market Misbehavior, I'm Dave Keller. Be well, stay safe, have a good one.